Before we begin, it's my pleasure to introduce our speaker for today, David Ng. David is a seasoned expert in the derivatives industry with years of experience. And previously, he served as the head of marketing at Phillip Futures, where he played a key role in driving growth and development in the derivatives market. Currently, David is a full-time proprietary trader with ExpertX, which is a local proprietary trading firm. With his deep expertise and industry insights, David brings a valuable knowledge to our session for today. So without further ado, I'm delighted to hand over the presentation to David. David, the floor is yours.
Yeah, okay. Thank you, CY. Just going to make sure that you can hear me clearly.
Yes, I can hear you clearly.
Okay, I'm just going to share my slides now. Are you able to see the slides on full screen?
Yes, your slide is out. All good to go.
Yeah, okay. Thank you very much, CY. Yeah, firstly, just like to thank Excellent as well as Bursa Malaysia for inviting me to speak on tonight's topic entitled, trading the gold market as well as the Chinese currency market, basically the USD CNH futures market is available on Bursa Malaysia. So as CY mentioned earlier, a lot of us, when we trade the local Bursa Malaysia futures market or derivatives market, we are keen to only know the two major product, which is the FGLD index futures and also the crude palm oil futures market. But a lot of people tend to forget that our local futures exchange also has a gold contract and also a currency futures market that enables traders to also participate in the market itself. So I think in tonight's session, I'm just probably going to give you some insights on it and also just to introduce the contract itself to the audience. So I'm just going to go to the next slide. So as usual, I think before I start, just like to disclaim myself, all the material that's presented tonight is purely for educational purpose. Any opinions that's reflected is purely based on my own personal opinion, doesn't reflect any opinion, whether it's from the organizers or whether it's from the exchange itself. And do make sure that if you are new to the futures market, make sure you're well educated. That as you heard earlier, Excellent has sessions on introduction to futures. So you are new to the futures market, I highly encourage you to participate in those sessions. Keep in mind, derivative also includes leverage, and therefore it requires experience as well as knowledge beforehand when you embark on the market. So with that, I think importantly, any views or any opinions reflected is purely for educational purpose. Now, in the next hour or so, I think what we're going to cover is probably looking at the gold and basically the CNH Chinese currency market. Now, these two products are currently available on Bursa Malaysia futures market. Now, volumes are a bit thin, but nevertheless, I think it's good to also know that the factors that actually drive gold, is actually quite a positive factors. And I think as long as you see it day in, day out, you see gold prices inching higher and higher, hitting all-time highs. I think it's a good time. It's a good opportune time to be in the gold market to gain some exposure. And I think the best place to be in is also on the local market. And it's not only on the overseas market that we can actually gain our exposures in the gold futures itself. Now on the Chinese currency market, I think for those who have heard, there's also a local, Bursa Malaysia also has a soybean oil contract which is denominated in RMB. So I think in that sense, you can also look at the Chinese currency futures as a way for you to hedge the risk in terms of currency risk. Also, you can also participate in, now US and China is indeed going into a trade war, perspective. So therefore, there's a lot of volatility in the market, whether it's a gold, whether it's in currency market, there is volatility. So I think it's an opportune time to start looking at these contracts. And when markets are volatile, there's always opportunity that we can embark on. Now, importantly, I think it's good to start off with looking at things on a fundamental basis. Importantly, looking at factors that actually drive gold prices as well as the currency markets. Now, importantly, gold is a hot topic right now because it's hitting all-time highs. There's always begs the question where can gold continue to rise even further? So I think it's important to assess those fundamentals now. And if you want to track whether gold can reach a new level, you really have to depend on whether what are the factors that drive, and are those factors can continue to sustain this kind of rally that we see in gold prices. Now, in terms of technical setups, I think market is trending. And whenever market trends, if you're a trend trader, there's always an opportunity. So I think gold itself is having a strong uptrend, and it still continue to do so. About Chinese currency, you really look at it, China's economy is, as we go towards later on the presentation, China economy is not doing on a strong footing, and as long as the economy is not on a strong footing, currency is going to be weak. So I think the trend for Chinese currency is pretty much on the downtrend for now because of the weakness of the economy, and obviously also with trade tension that's between US and China. So with all this confluence of factors, you can clearly see that trend that's in place in the market. And as a trader that you're watching the market, this is a good space to be in at this point in time. Now, last but not least, I think it's important to also look at things in terms of technical perspective. So I'm just going to introduce a little bit of trend tools that you can use, especially when it comes to moving averages, trend indicators that you can actually employ while trying to identify opportunities in the market. Now, so just going to go through briefly on the contract specs. You can get this on Bursa Malaysia website. So the gold contract is listed on the Bursa Malaysia Derivatives Exchange is called FGLD. Now they have actually revamped this contract last year, early part of last year, and you can see that this time is what we call a Quanto contract. The new contract is called a Quanto contract. The reason it's called Quanto contract because the contract multiplier is 40 contracts per unit. So in a sense that every tick movement, which is 0.1 US dollar, is equivalent to a 4 ringgit movement, or rather we call it a tick value, and it's a fixed tick value. Despite the good thing about the revamped FGLD contract by Bursa Malaysia is that now the price as quoted is denominated in US dollar. So in a sense that it gives you, when you're comparing other international gold prices, especially the COMEX gold, you can sort of like relate. Because given now that prices that you see on the screen, especially for the FGLD, is quoted in the US dollar, so it makes a bit of comparison easier, and therefore it enables traders to really anticipate the movement of the gold market. Unlike those days, when gold contract was quoted in ringgit, it was slightly difficult because people would have to do a conversion in their head. It's also not so simple. So therefore, I think when Bursa revamped the FGLD contract and make it denominated in US dollar, it makes it easier for a trader to really compare and contrast between COMEX gold prices as well as FGLD. So I think in the sense that it's a good contract to start off with, and the contract size is very small. So in the sense that it gives you opportunity and exposure for those people who intend to trade on the gold market. Keep in mind, I think every tick movement and tick value is actually fixed to a 4 ringgit. So there's no currency risk between the USD and the ringgit because it's fixed at 4 ringgit per tick value, per USD tick value. Now, trading hours are pretty much standard. Keep in mind now we also have a night trading session. So when gold markets gets a bit more volatile, especially during the US trading hours, at least there's an opportunity for you to be able to capture those opportunities, especially with the night trading session. Now, on a Mini USD CNH, is more of the Chinese currency futures contract. Now, this contract is again a very small contract. The contract unit is 20,000 US dollars. Now, obviously, the price is being quoted on CNY against the US dollar. And the closest is 4 decimal places, and which each tick value at 2 RMB per tick. So every tick movement you're looking at 2 RMB. It's against a very small contract. So trading hours are, again, you have the day trading session, you also have the night trading session. So it gives you an opportunity if you want to reflect your view when markets are volatile, especially during the US hours. You're still able to, you have a market that's still giving you that kind of opportunity to enter and exit. So other than that, just to also reiterate, the FGLD contract is still a cash settled contract. It's not a physically settled contract. So in a sense that you don't have to worry about taking delivery. Unlike that, if you trade palm oil futures on Bursa, it's a physical delivery contract. So you're always worried that at the end or when it close to expiry of the contract, you make sure that you're out of the market, or you have neutralized your position. If you're not, then you stand a risk of getting a contract delivered. But you don't have this kind of risk if you are trading on a currency or even the gold contract. So let's just dive into the fundamentals. We start off with gold. Now, gold is very interesting, hitting all-time high levels. In fact, I think 3,000 US dollar per troy ounce is in sight As we have seen in the past couple of days, gold is inching higher and higher to record levels. So there's a lot of factors that actually drive the rally in gold prices. I think let's just start off with just looking at one of the key thing is, economic growth. Now, economic growth, if you just look at some of the key reports, it does indicate that this year seems to be slightly better. I think you just look at IMF latest report, it shows that global economy this year should be progressing well, despite the US and China trade war. Now, things might change because Trump being Trump is very uncertain and very volatile. So, keep in mind, keep your positions tight, because when markets get volatile, sometimes projections can also get, far off. So I think this is where we need to, when going into 2025, this is where we really need to take note of, even though people are projecting, or even though institutions are projecting that economy should do well, but things can change ultimately. I think with Trump, being as it is, he's creating a lot of uncertainty in the market. So do be careful. Now, with uncertainty in the market is always a good thing for gold, because gold is always deemed as a safe haven asset. So whenever people are unsure of where the market is heading, where the global economy is heading, people rush into the gold market. So I think therefore gold has actually enjoyed a tremendous rally because of this element, because of the uncertainty that is coming ahead, the headwinds that's coming to the market. People are just buying to gold. Now, so you see the performance of gold. I think year to date, they're almost up by close to 30%. I think that's tremendous price movement. Now, whether this is continuing to sustain, it really depends on factors that's actually supporting the gold prices. If as long as those factors are still there and it's still a strong factor to be in effect, I think gold prices can still stay where it is. Now it's even performing better than US stocks. You have seen how the US Dow Jones, Nasdaq, and even S&P 500 has performed this year. They did tremendously well as well, but I think gold still continue to outshine. Now, I think the only thing that is underperforming is mainly the commodities. Now, commodities is referring to other type of commodities, mainly your energy sectors, your crude oil, or even to a certain extent your grains like your soybean, your wheat, and your corn. So these are the things that commodities tend to underperform, and obviously treasuries as well. I think we rates anticipate to stay where it is. I think now people are also shifting away their assets away from the fixed income and then going into the equities or even the gold market. Now, I think one of the key topic this year is really looking at inflation. Inflation is going to be a major concern, especially for the US market. Reason being is because we have seen this, we have revisited this early part when we came out from the COVID-19 pandemic. Everyone was so fearful, things are rising, prices are rising, so inflation was a major concern. As a result, I think US responded by hiking interest rate. I think it was the fastest interest rate cycle in history, whereby I think between 1.5 years they hiked almost 500 basis points, which is quite substantial. So as a way to combat inflation. Now, even though inflation levels have started to moderate, but with Trump coming in, with tariffs implemented across the board, and obviously with immigration policy, we actually try to repatriate people back to their country, and therefore they'll create a lot of inflation environment because workers are getting less. So therefore, I think inflation is going to be a theme again. And as long if you just look at US numbers, inflation numbers is actually inching higher and higher. What's surprising is also that besides general prices are going up, a lot of commodity prices in certain ways are also inching high, especially vegetable oil. In close example is basically your palm oil. So as long as commodity prices, certain commodities prices are rising, this will actually fuel inflation. And if Trump is not careful in combating inflation, it's going to be very stubborn. And obviously, one way to curb inflation is to always maintain high interest rate, and that would definitely not be good for the economy on the longer run. As a result, I think if you look at it, interest rate is going to be a factor again. Now, why gold is always in favor despite high inflation? You just look at over the years. People always say that gold is a store of value. And you just look at over the decades, you can clearly see gold maintain its prominence as an asset that holds its value despite a high inflationary environment. In fact, during a high inflationary environment, people will actually hold gold rather than other assets. So I think that's also important that people are also expecting that inflation is going to be quite stubborn. It's not going to come down, and I think it's going to stay quite elevated. Now, the reason why I want to mention inflation as a key point is because inflation does drive interest rates. As I mentioned earlier, because in order to fight inflation, you use a high interest rate environment to curb spending, to curb demand, and therefore will bring prices down. So when you have a high interest rate environment, normally, they don't tend to favor gold prices, because when you hold gold, you don't earn any dividend, you don't earn any interest. So it's a non-interest bearing asset. So obviously, when you have high interest rate environment, people will not want to, there's less tendency to hold gold, because there's obviously you have other instrument that gives you better interest, or even you put in your fixed deposit, it gives you higher interest. So therefore, gold tend not to be favored. But when you have inflation environment and you have a rising interest rate environment, it's a different story, and that's what we're seeing right now. Interest rate in US is still persistently high. In fact, if you just look at some of the forecast by Federal Reserve members, they're looking at, when we start off the year, when it came into, before Trump was being inaugurated as a president, people were saying that, oh look, this year 2025 probably we should see at least 2 or 3 rate cuts. Now I think the question is out of box. Rate cuts are still there. It's still in question. But really, I think people are slowly looking at potentially there'll be no rate cuts. In fact, probably there could be a hike in an interest rate. Now, with this such view in the market, especially when it comes to interest rate expectation, that means that high interest rate environment in US is going to stay. Now, as long as high interest rate environment, inflation is high, eventually it will benefit gold. And you can clearly see that over a longer run, despite gold doesn't give you any interest, or it's a non-interest bearing asset, when you have inflation plus a high interest rate environment, gold tend to be favored. So keep that in mind. Do watch out. I think inflation and interest rate is an important element to look at, especially if you are trading the gold market. Now, another important element for interest rate is also affecting the US dollar. Whenever you have high interest rate, normally you expect your US dollar to strengthen. Now, over the decades, you have seen the US dollar and gold is always an inverse relationship. It's not to say obvious, but in most times it is tend to be an inverse. Inverse meaning that you have strong dollar, people will not buy gold because gold is more expensive. When you have weaker dollar, a lot of people tend to favor gold. So right now you tend to see that this relationship tends not to hold, especially for the last couple of months. Obviously, there's other factors actually driving the rally in gold prices, and it's not US dollar. But if you just look at a longer term relationship, the inverse relationship between the dollar strength and the gold is actually quite is still quite persistent. Just that I think in recent times the relationship actually broken. So right now you have a situation where you have a stronger dollar, and also you have a stronger gold, you have higher gold prices, which is unusual. But I think the other factors that's driving the rally in gold prices is actually a stronger factor compared to US dollar factor. But having said that, I think in future when US dollar, the expectation of US dollar strength is going to get weaker because of the tariff, and because eventually if inflation were to come down, interest rate is going to start coming down, then US dollar generally will be weaker. And when that happens, that will be another support for the gold prices as well. So do watch out. I think we can no longer use an old relationship, historical relationship that that we think we can persist, because right now the situation in gold market is slightly different. We can see other factors essentially pulling and driving prices higher. So this is just to reiterate, interest rate and inflation is a major theme for gold this year. So as long as US inflation remains high, US interest rates remain elevated, you have a situation where gold tend to be favored in this environment. So going back to rate cuts, so again, we start off the year thinking that probably we're going to see 2 or 3 rate cuts, but I think as the previous FOMC meeting has actually indicated that I think rate cuts is pretty much out of question. Even if there's a rate cut, possibly there's only 1 rate cut for the whole year. Eventually, people are looking at rates to remain neutral, means there's no rate hike or rate cuts. In fact, I think if there's where circumstances permits, I think people will start thinking that rates can actually in fact go higher as a way to curb inflation. So inflation and interest rates is very a key thing to look at. And as long as inflation is persistently high and creeping higher, it's definitely going to be pressuring inflation, interest rates level. Now, what are the factors that actually really drive gold prices in at least the past couple of months? I think the main key thing is always the supply and demand dynamics. Now, Whenever you study gold market or you look at the gold market in general, the supply of gold is actually very fixed. There's only a fixed quantity of gold that's available and they can mine, whether it's supply on the ground or supply above the ground. So its supply doesn't change much. You don't expect suddenly 1 year you start to see there's a huge supply of gold. It's very rare to see that. It's more of whether you have whether the gold is under the ground or above ground. So supply is fixed. The only variable that is changing and is important element for prices is always the demand factor. So if you just look at this chart here, you can clearly see that, you know, for the past 3 months, at least at the start of probably starting November last year, you can see the demand in fact increased quite substantially. And what contributed in the demand for gold, if you split the demand for gold into 4 major categories, which is we have jewelry, technology, investment, and central banks. You can see that clearly the central banks and jewelry is what drive the major rally in gold prices. So watch out. I think the next couple of months, as long as this demand stays strong, you should see gold prices holding well. But if you start to see demand taper off, now jewelry demand is a very I would say is more to buyers being very sensitive to price. And you know, the biggest you know, buyer of jewelry, gold jewelry, is always India. Now, India is a very price sensitive consumer. So as long as prices are inching higher, record levels, they probably sooner or later they probably have to taper off or they start to slow down their purchase of gold because gold is getting more expensive. So when you start to see jewelry demand starts to come down, I think that's usually an indication that probably prices may reach a short-term peak in bullishness, and that's where you need to be careful. So in terms of factors to watch out, demand is a crucial thing for especially for looking at the gold market. And jewelry is the way we see it, the demand is going to probably taper off because, you know, India is very price sensitive, and I don't think they're willing to pay high prices, you know, record prices for jewelry. So I think that's something to watch. But the element that is giving a bit of positive factor is the central bank, surprisingly. Now, if you just look at since the start of 2022 or the first quarter of 2022, you can see this, you know, purple area here, which is indicate the demand from central banks. It's actually going very well, and I think majority coming from China. So China central bank has really been buying gold massively since the early part of 2022, and it's consistently every month buying you know, huge amount of gold, physical gold from the open market, and this is what's supporting prices going forward. Now, if you just look at ETF, which is basically indicated by investments. Now, in the past, I think just this figure came out in January. You can see that in the month of January itself, the ETF inflows in gold is actually on record level. It does tell you that, you know, even when gold price reaching all-time high, you still see, you know, ETF flows coming in, which is a good sign. That means, you know, this rally that you see in gold prices, there's still support, there's still legs in it. But keep in mind, one thing to take note of is that this is quite imbalanced in the sense that the majority of the ETF inflows are coming from the US side. Now, there is a lot of theory as to why US suddenly starts to, you know, demand a lot of gold, whether it's on the investment side, whether it's on the physical side. This got to do a lot with tariffs. I think with Trump implementing and imposing tariffs across the board and to different countries, you can really see that a lot of these physical miners, especially in US, or even you know, companies in US, are starting to repatriate or whether to put in more fund inflows, especially for the gold market, back into the US as a way to, you know, counter tariffs imposition across different countries. Whether that will be a case remains to be a theory, but I think it's what we can see from the data itself. You know, as long as ETF flows are strong, it does support the gold market in general. Now, if you just look at it, you know, it's not only US, China is also a very big major buyer, as I indicated earlier, especially China Central Bank. So I think as long as one key thing to take note, if ETF flows are positive and if countries are buying gold, it should support gold prices. Now, there's also theories as to why China is buying a lot of gold, whether it's a way to counter US dominance in terms of using dollar dominance, or whether there's a way to diversify their reserve away from US, you know, holding less of US Treasury and buying into gold. That's again is a theory, but no, based on data they are saying is a good sign. You know, as long as, you know, China and US is pumping a lot of demand in the market, it's definitely going to fuel prices higher, and it's going to be a support for the rally. So key thing to watch, if you are watching the gold market closely, be very sensitive when China and US starts to slow down. Now eventually they have to slow down. They can't be buying gold prices at high or elevated prices. They have to wait for retracement, or there's a softness in the market or in prices where they start to purchase again. So you have to watch out closely. But I think US and China is major factor that's driving the gold prices higher. Now, as I mentioned, I think really this US-China trade war is what is not creating chaos only in the equity space, but it's also in other commodities, and in particular the gold market as well. With tariff imposition, I think people are afraid of uncertainty ahead. So what they do is that they quickly, either they repatriate the gold, especially in US case, they repatriate the gold back, back to their own shore, and as a way to counter the tariff imposition. But generally, if you just look at it, tariff is never good. Imposing tariff is never a good thing. Over on the longer run perspective, you can see that generally the economy growth starts to slow. We have seen that in the first term in Trump's presidency. You can see that the US economic growth actually slowed down in the first term when they started to implement tariffs. So crucial whether the second tariff will Trump be more aggressive, or he put lesser stance and negotiate more stuff on the table is still a question mark. But I think that's will create a lot of volatility in the market. So I think tariff basically gives a lot of impact. I think one of the major impact is definitely giving. If you just look at it, it's not only economic growth that's impacted, it's also unemployment. And if you just look at it, despite Trump tend to always point a positive picture, but you just look at the stats and numbers, sometimes it's actually a different scenario that's painting. So really, I think it's still too early, especially on the second term, to see the impact on the second round of tariff. But I think tariff in general may not be a good thing, especially over the longer period. And I think as long as US equities markets are hoping that US economy can sustain itself. But when tariff impact starts to hit the economy hard, I think that's where equities also tend to fall off. Now, eventually, all this will tend to benefit gold ultimately. So with tariff coming in and kicking in for the second time this time, again, is creating a lot of uncertainty, and therefore is also putting people, a lot of fund managers, especially in US, is also trying to diversify away from having too much concentrated risk on the equities market and put a bit more into the gold precious metal space as well. So I think really central bank is the key buyer. Besides jewelry demand, central bank buying has actually been very positive. Now again, there's always a period where when prices are too high and it's too expensive to purchase more, the central banks can slow down. And when that happens, you can see there's potential correction in gold prices. So you have to take note of that and be mindful that whenever this data are made available, do response accordingly. I think importantly, demand factors that drive the market is still very sensitive to the overall price of gold in a general sense. So just to reiterate, I think central bank buying has actually been very strong. Like I mentioned, China starts to buy aggressively in the first quarter of or late part of 2022, and it's consistently building up. So I think that's also what explains why gold rally from to below 2,000 to where we are close to 3,000 per troy ounce. That's a tremendous rally over a short period of 2 or 3.5 years. So important, crucial to watch. Central bank buying is a major key. And as long as central bank buying remains positive, that is something good for overall gold prices in general. Now, I'm not going to go too much on India. India, again, is a very jewelry demand centric. Jewelry is a big segment in the gold, overall gold demand. So as long as India, whether it is to fight inflation or whether they believe that now they have more spending power because they've been keeping gold for quite some time, and gold prices are actually inching higher or record levels. So therefore, their wealth effect is actually increased. Also, that will again prompt them to even buy more gold. But again, it's also, like I said, consumers are very price sensitive, and as long as gold prices inch higher and higher, that will probably taper off demand going forward. So be mindful, and as long as there's weakness in India jewelry demand, I think that's usually be the first sign that market is probably going to be peak at that point in time. Now, I just want to share with you this chart. This is looking at gold and equities market. You can clearly see that gold tend to move quite parallel with the equity space. Now, this is again very unusual dynamics. There's always a saying: gold tend to do well when equities market panic. We have seen that in global financial crisis. We have seen that in the last pandemic when equities dropped like 30%. People rush into gold. So gold is as a safe haven asset remains relevant. But now you see a different scenario. Now you see equities market are hitting high, but you also see gold prices hitting high. So I think this is what explains this phenomenon is you can see that a lot of fund managers are clearly diversifying their portfolios into the precious metal space. Like I mentioned earlier, things are going to get more volatile. And with record levels of equities market, valuations are overstretched. They're bound to be a sharp correction that is imminent. And as a way to protect that risk, gold is a good asset to hold. And I think because of that diversification, because of the fund managers diversifying into the gold market, you can see the rally in gold prices, which is quite parallel to the rise in the equity space. Like I mentioned, this relationship is very unusual. And if you trade on those days where if you see the S&P 500 is down, you should buy gold. If you do that, I think that's you are just landing yourself in a bit of trouble, because that relationship doesn't hold in this period of time. So be mindful. If you look at relationship that used to hold, I think clearly gold is fundamentals are different dynamics now. And that's where we again as a trader need to be very careful and be mindful of. Now, so I discussed on the key factors that drive gold market. Now I just want to bring attention to comparing our local gold contract, which is the FGLD, against the COMEX prices. So you can see there's quite a close link. Now, it's not a clear way to arbitrage between both markets, because clearly both contracts are slight. There's a difference to that. There's still a slight difference to the contract, but in terms of dollar to dollar comparison, it's actually quite close. So if you want to gain exposure to COMEX gold market, I think FGLD can be quite a good example, or quite a good platform for you to gain exposure, because I think the price difference, although there's in a certain ways there's certain gaps, but in most times the gaps are actually very minimal. So in a sense, FGLD trade quite closely to the COMEX gold prices in general. Now, this is one I want to highlight. So going forward, VIX is a measurement of barometer of fear index, which tends to measure how fearful the market is. When you have high VIX index, it's telling you that people are generally very fearful. We have seen that during the height of the pandemic. Now, given that Trump is in, there's a lot of news flow, and again that will shock market. So VIX is, you look at where VIX is now, you can see that VIX are also inching higher, especially at the start of January when Trump just got inaugurated. So going forward, when you have high VIX index telling you there's fear in the market, it's always benefiting gold prices. So we are now in a period there's a lot of headwinds, whether it's geopolitics, whether it's economy headwinds. Ultimately, I think all this confluence of factors is going to push gold prices even higher. Now, talking about precious metal, obviously we have to also talk about silver, which is like the other long lost brother. So if you just look at it, comparing the ratio between gold and silver price for over a period of time, there's a common average ratio that we look at is about $80 or 80 multiple in terms of gold prices to the silver price. It tells you how relatively expensive gold is compared to silver. Now, when those ratios hit above 80, it's telling you that gold is way overpriced, or rather silver is underpriced. So right now, I think the ratio is doing close to about 90. It's telling you that I think gold is clearly more expensive, and it's showing you there's a bit more potential in silver. Regardless as it is, gold and silver is still a precious metal asset, and when factors benefiting precious metal, both gold and silver will tend to move in tandem. Just that now, I think if you look at opportunity-wise in terms of price relative, silver tends to offer a bit more upside compared to gold. But having said that, I think precious metal will benefit eventually. This not in light of all the factors I mentioned. Now, I think you have heard over the news, one of the major drivers for gold prices in recent weeks is also because there's in identification, or rather there's a bit of a scenario where the physical market, the gold physical market, is actually getting very tight. Tight in the sense that there's a lot of demand, but there's not enough supply, or the supply doesn't react to the demand in a fast way, therefore pushing prices even higher. We have seen that, if you just look at the ETF flows, where I showed you the earlier chart, US suddenly increased such a tremendous flow, investment flow into the gold market, demanding for more of a physical gold market space. So that's creating a lot of what we call premiums in the market. So there's a dislocation between the COMEX price and obviously the physical London prices, the LBMA prices, and that caused a lot of arbitrage profit in between. So that means a lot of people will probably be selling, or rather buying London gold, which is cheaper, and selling in the COMEX gold. We've seen that a lot of scenario, but all this does indicate that to you that I think US, or in particular, is actually repatriating back a lot of their golds from other countries back to the US market. Whether this is as a way to respond to tariff, it's still too early to tell. But I think that's creating additional, drivers for the gold prices. Now, I think this situation will not last. Eventually, I think the market will self-correct, and I think the premium we are seeing right now will slowly start to diminish. And when that happens, that will reflect into lower demand going forward. So do be mindful. This physical tightening is just a temporary scenario we are looking at. Eventually, the market will self-correct, and the dislocation will be faded away, and that's where we really need to take note of. We need to really take note of as well. Okay, so going into the next currency factors. Now, I think currency factors is a slightly different dynamics altogether. Now, currency plays are very much driven by economy, and as long as the economy is doing well, you should see a stronger currency strength as well. But if the economy is not doing well, you should see weaker currency. So with this regard, I think the USD CNH is a very is a reflection on how the trade war is going to play out. So both countries, US and China, obviously want a weak currency in a way to make sure that their goods are competitive. When you have two currencies competing for the same market and using currency as a weapon, you're definitely going to see a lot of volatility in their respective currency. So this USD CNH pair is going to get interesting in light of all the tariff that we are seeing from the US and China side. Now, going to China economy, I think China, there's nothing much to shout out. In fact, I think you look at it, this year they have toned down their message in terms of their economic optimism. I think if you look at growth story in China, this is pretty much quite still in doldrums. I think there's not much of optimism in the air, unless I think data starts to show or does indicate that growth starts to reach a pivotal point and starts to go higher. Until then, I think it's still pretty much in doldrums, and I think growth factor in China is still pretty much out of question for now. Now, when you look at it, I think China is having a bit of struggling in the sense that in its own economy. If you just look at the forex flows from China itself, it's actually they recorded a lot of outflows from China. It tells you that I think people are moving away assets. I think these are all in preparation of tariffs. When US starts to implement tariff, a lot of China foreign holders starts to sell China and repatriate back their money into the US market as a way to counter the tariff move. So as long as tariff are still as long as US still insisting on imposing tariff and China to reciprocate with their respective tariff, we can see fund outflows away from China will be quite tremendous. But again, these are all foreign flows, and foreign flows to a certain extent may not give much of an impact, but it still remain quite significant. Now, in terms of their own internal domestic economic, the issues is always about prices. And look, if you just look at prices month-to-month basis or year-on-year basis, it's actually declining. So China is pretty much lost in translation when it comes to general prices. And we term that China is actually entering the deflation mode. It's pretty much like what Japan has entered the lost decade, where you start to see, the economy is not doing well, prices in general is not going up, the demand is not there. and that will be a major drag for the economy. I think China will not want that. So I think going forward, whether China will aggressively try to pump prime the economy, with that, I think that will affect the currency as well. So if you are trading this currency pair, you have to watch out news flow coming from China. And China news flow can be quite erratic. There's no fixed period where they announce certain things. There's always up to the whim and fancy of the administration. So as when they deem that's necessary, they will announce something. They'll announce a package of stimulus, and that will really affect the currency movement in the USD CNH. So if you trade on the Chinese currency, you have to be very careful whenever the government announce certain policy measures. So China, major thing is always the price level. They are facing what we call deflation. As if you compare to US, it's a different story. US is solely might be facing an inflationary environment. So it's a very diverging economy. You have China that is going on the deflation mode. You have US that's going on an inflation mode. So clearly these two economies are clearly diverging itself. Now, I think as a result, to try to contain the deflationary environment, I think China is massively cutting rates. Now, personally, I think this may not be sufficient. I think the bullet that they need to do is they have to be even bigger. And I'm not sure how they're going to do it, but I think cutting rates is not going to be may not suffice enough to pump prime the economy. So I think China itself will really have to figure out, especially in terms of administration, will have to figure out something that's in greater when it comes to stimulus measures, in order to really boost the economy. Now, if you just look at a currency pair, the USD CNH, which is highlighted in red, if you compare with the US dollar, the DXY or dollar index, we call it, you can see there's quite a close parallel. So whenever US dollar strengthen, the Chinese currency will weaken, vice versa. Now, obviously, there's a bit of dislocation in recent times. You can see both currencies are also getting weaker. But in most times, when US dollar starts to strengthen, you can start to see Chinese currency gets to get weaker. Now, it's always the intention of certain countries to maintain a low currency level, because that will make their goods more competitive. Again, currencies also reflecting its economic performance. So in a way, you really have to see which degree of control that the government wants to maintain a certain level of currency weakness level. You can't maintain too low of a currency weakness, because that will eventually signal to the major markets that the economy is not doing well, and that will further pressure the market, and that will create a lot of import inflation or inflation environment for the country, and it will spiral. So I think China is, you just look at what the government is trying to do. It's trying to maintain at a certain range. You can't let the currency weaken too much, but you also can't let the currency weaken, or appreciate to a certain level. So it's trying to maintain a certain balance. But it's a very difficult move, because if the economy is not doing well, it will clearly reflect on the currency itself as well. Now, if you just look at a contract that's traded on the Bursa Malaysia, is clearly on a USD CNH, which is the offshore currency. Now, China have offshore and onshore rates. So one is USD CNH, which is the offshore, which is what is traded on the Bursa Malaysia. We also have the USD CNY, which is mainly an onshore currency. Now, the difference between offshore and onshore currency is that offshore are mainly traded by foreign players. The USD onshore markets are mainly traded by the local Chinese players. So, there's always a price difference between the USD CNH and the USD CNY, offshore and onshore currencies. Major reason is because the offshore, there's less, the government can't really control or in a way try to maintain a certain degree of control in the offshore currency, because it's a market where a lot of foreign players can also participate, and therefore can also try to determine prices as well. While onshore currencies, the government has more control. The government can implement measures, can implement policies to restrict demand and supply of local currencies, but they can't do it on the USD CNH. So therefore, USD CNH will tend to show more weakness, because it tends to reflect what the outsiders are looking at or gauging where the Chinese currency market is. So whenever you look at offshore currencies, especially RMB, you really need to think of that. It's a reflection or it's a gauge on how the overall market is perceiving the Chinese currency to be. While if you just look at the CNY, which is an onshore currency, sometimes because there's always a degree of control by the government as to certain levels that they want it to go. So in a sense that it's always tend to be stronger as compared to the offshore currencies. So offshore currencies gives you a better reflection on the actual rate, or indirectly is also the actual economic performance in China. So do notice the difference and do note the difference. But what we are trading on the Bursa Malaysia pair is basically on the offshore currency, and it's not the onshore currency. So going back into the main discussion, I think China is facing a bit of economic doldrums. One thing is they're facing deflation. Second thing is the persistent housing crisis in China is really still ongoing. Like I mentioned, house prices is, house as an asset is not liquid as compared to other asset classes like equities or even gold. So when you have a crisis, especially in real estate space, which is an illiquid market, for it to create the kind of stimulus, it takes time. So I think stimulus measures are kicking in, but you only tend to reflect it takes a couple of years or a few quarters minimally. So if you just look at latest numbers, I think China home sales numbers are still showing you that there's still weakness there. And as long as home sales are not coming up, people don't feel confident enough to spend, and that would be a drag to the economy. So China is not only facing deflation, they're also facing housing crisis in general. Now, this is what happened in China market last October, where the government suddenly just announced a massive stimulus package, a massive cut in interest rates, overnight interest rates. But that, we start to see the major impact in the short term. But since then, I think markets start to see that it may not be enough, it may not be sufficient, and there should be more round of stimulus from the government itself to really try to give confidence back to the economy and try to encourage people to spend. And that's a way to stem the property crisis. But as of now, you still see that the government is still watching closely. If the measures are not enough, I think there'll be more measures that will be expected going forward as a way to prop up the Chinese economy. I'm not going to go too much again. This is just to highlight the property crisis. It's ongoing, and like I mentioned, it's not easy to solve because real estate as an asset is a long-term asset. It's not so liquid like what you have in equities or in the precious metal, where a sudden decision, a sudden government intervention can really change the course of the market. But it's not. It will take a while especially for real estate markets, because the generally is quite an illiquid market in general. Now, loan growth, again, this is all reflecting the property crisis. As long as people don't have the confidence to spend because the house prices are coming down, therefore they are not going to take more loans as well. So generally, when you have a slow loan growth, your economy again will not do well. Now, these are all important parameters to look at. If you're looking at when the rebound in China's economy, you just have to look at the stats in the housing stats. If loan growth starts to taper and start to moderate, and you start to see loan demand coming back, that could be a sign that Chinese consumers are starting to come back to the market, and probably that possibly that the government measures are starting to get impact. But up until then, you still see that generally China consumers are facing quite a tough issue to solve, and I think the Chinese government is probably going to take a bit of while for measures to really kick in to the general economy. Now, besides that, if you just look at yield levels, before the hike in US interest rates, China used to receive a lot of inflows because the China 10-year treasury yield was actually quite elevated. They're probably offering close to about 3.5 to 4%. But since then, you can start to see the gap between the US yields and the China government yields or treasury yields are starting to narrow, and in fact now it's actually become a premium market for US. That means US treasury market is definitely in favor. They are offering higher yields as compared to China. So therefore, that explains why the forex outflow has actually been massive, and that this kind of outflows will cause a lot of weakness in the RMB currency. So Chinese currency face a lot of pressure because outflows are keep coming out, because a lot of people are repatriating back, especially the foreign fund managers are repatriating back their flows away from China and back to the US market to enjoy a higher yield. So I think this kind of fund movement would definitely be pressuring the currency space. So if you're trading the market, you have to watch out. I think the yields will get more diverged. If US interest rates continue to stay where it is, in fact, if they continue to go higher, you can start to see this yield differential to get even wider. And when that happens, you start to see more outflow coming out from China and into the US market. So again, I mentioned, China used to enjoy premium, but now they are actually enjoying a discount, which means that the Chinese treasury yield are actually at a discounted levels compared to the US treasury yield. So it does indicate that this fund outflows is going to be quite massive going forward. If these spreads continue, people tend to favor the US market rather than the China market. Now, these are basically the China policy stand. I'm not going to go too much on it, but basically it tells you that is this property crisis is going to stay, and if they don't do something drastically in the next couple of months, and that will really be something that's going to weigh down the market. So if you're trading in Chinese currency, you have to watch out. If there's a sudden announcement, from the government, Chinese government, whether to pump the economy, that you start to see a sharp decision in the CNY currency. But up until then, I think the trend for Chinese currency is still on a downtrend, mainly because we don't see sign of growth, or we don't see sign of strong growth coming from China in a short period of time. Now, just want to touch a bit on US tariff policy. If you just look at the major US tariff policy that's being implemented by Trump, is focused on three main pillars. First thing is about border security. Second thing is about fairness. So whichever country that charges tariff to the US market, US will always reciprocate now. And other than that, it's always geopolitics. Now, geopolitics is very sensitive in the sense that in a way is very targeted and selectively targeting certain sectors that only benefits its own country. So again, these three major pillars, if you just look at how it's being implemented, is only pointing to one country, which is China. So US-China trade tariff or trade war is going to get more intense, and it's not going to ease unless there is negotiation on the table where both countries starts to negotiate on certain leeways. Then we start to see the ease of the tension. If not, it's going to be very difficult. So I think do watch out. I think this US tariff policy is going to create a lot of chaos and havoc in the market. Now, if you just look at it, since funds are moving back to US, the key question is, as part of negotiation deal with China, will it demand China to also invest in the US market? It's still too early to tell. And Trump being Trump is a very uncertain guy. So when it comes to policy measures, I'm not sure what's going to be negotiated, whether there's a bit of leeway when it comes to tariff policy, but I think anything can be on the table. But I think whether China investing more into the US market as part of the negotiation, trade negotiation, is still too early to tell. But what's important to take note of is that I think US is determined this time around to rein in on the trade surplus with China. I think China has recorded a massive trade surplus before Trump got inaugurated, because I think people are fearing that tariff will be something that's going to block trade. So a lot of people actually expand or rather export all the way out just before Trump entered into the White House. So you can clearly see, I think China's surplus is going to continue to record levels. I think that's going to change as tariffs are kicking in. That will divert a lot of goods away from China and to other countries. So tariffs are a major thing, and it's going to create chaos in terms of currency as well, as I think it's going to benefit gold eventually. So do watch out. I think tariff is again the most important theme for this year. Trade war is going to be very persistent and a major recurring theme that's going to drive markets across the board. So going to the last bit, looking at trends. So having said that, all the factors I mentioned, the fundamental factors I just shared, all these factors will definitely affect markets. Then how do we understand by understanding factors of markets, how do we position our trades? I think one of the ways is to look at things on a technical perspective, and one of the ways is, if you are a trend trader, you try to find trends in the market. There's a lot of tools that you can use to identify trends in the market. For myself, I always use Heiken Ashi as a Heiken Ashi is just a candles that identify trends in the market. So there's many other ways, and I think Heiken actually is one of good ways because it's simple and it's easy to use, it's easy to interpret, and obviously you can pair that with moving averages, which is also a trend tool, and also DMI crossovers, which is also a trend tool. Now I just want to touch a bit on DMI on the later slides. Now DMI is a great tool if you're doing trend. Last but not least is which in every trading plan you always must have a way for you to measure your loss. Profit is a must, but I think managing a loss is critically very important. And one of the ways is to use ATR, what we call average true range, as a way to manage our risk, which I'm going to share on later part. So important to take note, this is pretty much the criteria that we can use when we construct a trading plan. By looking at, firstly, if you're a trend trader, trends in the market, and use trend trading tools to pair that to identify entries and exit strategies. Now, if you just look at gold in general, you just look at how gold has been performing. Generally, I think gold performance has actually been quite strong in the sense that you can see candles are both the 50 and 200 period EMAs. That tells you generally the market is on an uptrend and still on an uptrend market. Now, I always believe this notion that when the market trends upwards for a long period of time, it's generally not healthy, because in a healthy trend you should see a bit of healthy correction, because the market the momentum tends to fade, and market doesn't just go on one direction all the time. So generally I think for a healthy uptrend to persist, you need to see a bit of retracement in the market. So I think generally gold, whether we should see the retracement in coming days or weeks is definitely going to be indicated by technical perspective, but I think the overall trend for the gold market is still an uptrend market. Now, the reason why I mentioned trend is because once you identify the trend is an uptrend market, find position for you to long rather than short. Trying to time the reversal in the trend is never easy, because like I mentioned, this trend can stay for quite a long while, and if you get stopped out, if you try to find short positions in a strong uptrend, you tend to get stopped out most of the time, and it's not an easy business to be in. Okay. Now, if you just look at over a longer period, you can see that gold really is on a different trend right now, and it's clearly on a bull cycle. Now, whether that will take you to another level is still yet to be seen. But I think as the factors I mentioned earlier, if those factors are persisting for this year throughout, I think gold can reach another level. I think it easily can cross the 3,000 without a doubt. But importantly, you must have strong factors to support. If the factors are not, whether the momentum starts to diminish or the factors are starting to erode, that's where you tend to see prices of gold tend to peak, and that's where you need to be careful. You're still holding long positions. That should be an area where you need to get out. You are still holding long positions. Now, besides that, you can obviously pair that, using moving averages as a way to look at it. Moving averages is also acting as a support and resistance level to the gold market. You can clearly see, I think gold is still remain very, despite hitting all-time highs, is still trading above the short-term average, and the average line is probably doing about 2,800 per troy ounce. As long as markets are above 2,008, it's still telling you the market still have a bit of potential upside in the future. So gold trends still indicates to you that the market is still trending higher. Now, if you just look at CNH, the Chinese currency pair, the 735 is what we call a critical level. This is what the government also deem it as a critical level. So anything that's above 735, I think the government will start to step in. But technical perspective, you can see that the weakness in China currency is actually quite persistent, because as I mentioned earlier, the economy is not doing well. Obviously, with governments starts to step in when measures are kicking in, you start to see strengthening in the currency. But until then, I think generally the trend for the Chinese yen is always tend to be weaker because of its economy. So generally, I think the trend is still an uptrend, which indicates to use a weaker currency. And I think 735 is a level that's very resistant, because I think the government don't want this level to break the 735 level. It's a psychological level. If it does break that, it's telling you that there's going to be massive outflow, and that will create a lot of panic in the currency market. Now, just to share with you, using Heiken Ashi is a great tool to identify trends. So Heiken Ashi is one part of Japan's candlesticks. and it's just reflecting the average bar. So you can see that, by looking at using Heikin-Ashi charts, or Heikin-Ashi candles, you can identify short-term trends in a clearer manner. So these two charts are mainly the gold charts, same time frame, same period. The only difference is the type of candles. So Heikin-Ashi, if you compare it, it does indicate to you the trend in a clearer manner. So if you see green bars, it generally tells you that the market is bullish. If you see red bars, generally tells you the market is bearish. The reason why Heikin-Ashi is widely used as a trend indicator is because it's simple to identify trend and simple to use, in a sense that there's only 3 major patterns that you need to know. As long as you see a green bar with an upper wick, it's telling you that this uptrend is started, or there's a momentum in the uptrend. Vice versa, if you see a red bar with a lower wick, it's telling you that the market is on a downtrend. You see a series of red and green together with small body, like a doji type of candles, it's telling you the market is moving sideways. So very important to take note. If you are holding a long position and you start to see the body of the candle starts to get smaller and start to see the appearance of red candles, although like a doji type of candles, that generally tells you that the uptrend market is probably going to be peak at that point in time. So if you're holding long position, you start to see this type of candles, you should be out of the market. Now, just to show you the dynamics of it, as you can see that, these green bars are getting wider in terms of their body. That tells you this uptrend is getting stronger. Vice versa, these red candles, the bodies are getting wider as well. It's telling you this downtrend is also very persistent. Now, if you just look at this part here, you start to see small body candles, red and green together, side by side. It's telling you that this market has no direction. So if you are, you start to see these candles, again, you're holding position, you should be out. And if you're using trend trading, especially during a side range market, it's very difficult because you get a lot of false signals. So therefore, you get in and out quite often, and therefore, you get stopped out quite easily as well. Now, USD CNH, so Heikin-Ashi can be used in any markets, but again, importantly, you have to adapt that to the respective markets. Each market doesn't behave in an exact manner. But again, the interpretation of Heikin-Ashi remains universal. So that means, whenever you see red Heikin-Ashi bars, it's just telling you that the market is going down, going potentially on a downtrend. Green color body bars is telling you the market is going on an uptrend. Especially when you see strong body candles, especially during a congestion period or sideways market, is telling you there's a breakout of the trend and the market is going to start trending. And that usually be a good opportunity for you to gain position. Now, this is an example on the USD CNH. The reason there's a big buy here is because Trump announced something, especially on the tariff announcement, the 10% tariff announcement on China. You can straight away see the currency market starts to react. So now, if you're in the currency market space, you really have to be careful when, whether Trump says something, you have to watch out on his Twitter post, because that will create chaos especially in the currency market. Now, you can incorporate moving averages. So moving averages together with Heikin-Ashi can give you quite a good signal, in the sense that, moving average, you can use 2 different types of varying periods. One is shorter term, one is a longer term. So crossovers are simple in the sense that whenever the shorter term crosses above the longer term, is telling you the market potentially is going to go higher, bullish phase. Vice versa, if the shorter term crosses below, it's telling you the market is potentially going on the lower basis. It's a bearish crossover. So you can clearly see, I think moving averages not only giving you signals for you to tell you the direction of trend, so telling you that you look at where this is a gold market, you can see that moving averages tends to give you a bit of moving dynamic, moving average support levels and resistance levels. So you can see that candles are well supported along the lines. The moment you break the lines, telling you the market potentially may head to a potential downtrend. As we can sample here. So moving averages not only tells you your crossovers, but it also act as a support and resistance to your price levels as well. Now, I just want to introduce a DMI. DMI is also a great tool for if you're using trend trading. So DMI consists of 3 different lines. One, we have the black, the ADX line. We have the green and the red. Green line is basically the positive directional index. The red is basically negative directional index. So crossovers on DMI are simple. The moment when you start to see the positive green line, which is positive DI, crosses above, it's telling you the market is poised to go higher. The key thing you look at it, if you compare, is sending you quite similar signals by using a moving average crossovers. So DMI crossovers and moving average crossovers are very similar in the sense that they give quite similar signals. Same goes for here. You start to see when negative DI crosses above the positive DI, it's telling you the market is going to hit downtrend. And true enough, there's also a bearish crossover on the moving averages. So DMI crossovers and moving average crossovers are very similar in certain ways. But what's important is the black line, which is your ADX. So this ADX measures the strength of the trend. So in this example, you have the positive DI crosses above the negative DI, showing you the market is going higher. But the black line, the ADX line, is rising. So when ADX line is rising, it's telling you that the market is heading higher. So that tells you generally this uptrend has momentum. Now keep in mind, when ADX, the black line, starts to decline, it's telling you that this uptrend is losing strength. So when ADX starts to come down, that tells you that this uptrend is probably going to be peak and may head to a different direction. So ADX gives you additional information on the strength of the trend. So not only tells you the DMI doesn't only tells you the direction of the trend, but it also tells you the strength of the trend, which is very important. So ADX is based on a value. So I would say that the common rule of thumb is any value of ADX above 25 is telling you there's trend. Anything below 25 is telling you there's no trend in the market. So when there's no trend in the market, you shouldn't be using trend trading tool or trend trading strategies. Sideways market, you should be using mean reversion or any other strategies as well. So keep that in mind. ADX is based on a value. Anything that's above 25 is telling you there's a trend. So example here, you can see that, and importantly, you can, during the downtrend market, you see ADX rising is telling you that this downtrend is gaining strength and momentum. So ADX doesn't tell you direction. It's just more of telling you whether the trend is there strength in it or not. So once the trend loses strength, the ADX will start to decline. So importantly, always pitch the value of the ADX. So example of an entry strategy here, you can see that this bullish Heiken Ashi candles by the green Heiken Ashi candles, and there's a bullish crossover on the moving averages, and it's clearly identified by the positive DI crosses above the negative DI on the DMI indicator. But what's important also is that this ADX starts to go above 25. So there's an indication, there's a potential indication that this uptrend may just be starting. So it's a good time to get an entry signal here. Now, once we identify entry signals, it's also important that we make sure that we manage our loss accordingly. Markets doesn't always go in our favor. We have to acknowledge the fact. So we have the key thing to protect ourselves is that we must have a way to get ourselves stop out just in case we are wrong. And the way to do that, one of the ways to do that is to look at ATR value. ATR stands for average true range. We measure the range of the day. So example here is you just look at ATR value of 7. Just a gold market long entry is being indicated, and you just long at 27.05. If you work on a risk to reward ratio of 1 to 2, that means you're looking at a risk of 7 points and a reward of 14 points. So that's how we use the ATR multiple. So if the ATR is higher value, that means you're preparing to set yourself a higher stop loss figure and obviously higher profit target. So that's how you work on the ATR multiple. But again, the risk to reward ratio is very individual. So certain individual may use a lower ratio, certain individual may use a higher ratio. It all depends on how comfortable are you in absorbing a loss. So this is what happened next based on the trading plan that just executed. So again, importantly, you must have your stop loss in place. In case the market go against you, you get stop out and wait for the next signals to appear. Now, this is another example, but this time it's on Chinese currency. Here you can see the bullish candle on your Heiken Ashi, bullish crossovers on DMI, and the key thing is that the ADX is starting to rise. So that tells you that this bullish trend may start to gain some strength and may even go higher. So going based on these parameters that I just mentioned, if you just look at gold itself, generally is still an uptrend market. If you just look at ADX value, is still rising. It's still showing you that this uptrend, there's still strength in it. Up until when I think ADX starts to peak, I think that's where potentially, technically, the gold market may face a bit of resistance, and that's where you need to be careful. Now, in terms of Chinese currency wise, it's still showing you weakness. It's still an uptrend in the sense that Chinese currency is getting weaker. ADX is still rising. That tells you generally, I think, as long as the economy is still not doing well, the data is still showing you quite bearish. The market generally is still quite negative at this point in time. So last but not least, just want to emphasize this point for those who are new to trading. People are so fascinated or so obsessed with getting it right in the first time by making sure that they always make. It's all about making profit. But I think the truth of the fact is, I think it's all about minimizing your loss. Just to show you the breakdown, if assuming that your loss is 50% of what you have entered, your recovery is 100% of that. As simple as that. So the less, each time you make a loss, the lesser it is in terms of the amount, the faster you can recover, and therefore I think it ensures that your survival rate in the market is much higher. A lot of common mistakes, especially among the new traders, is that they always let their losses go wide, and eventually their account will go bust, and that will make it difficult for the person or the individual to make a comeback into the market. So always make sure you keep your losses small. So why trade gold? Just want to final conclusion points. Gold is as a safe haven asset. It's very evident. Second thing, inflation in US is something that is to be watched out for. As a beneficial, I think gold will tend to benefit. As a store of value, I think gold has proven time and time again, over the decades or not, over the centuries, gold has risen in value. And as a store of value, I think it's as an asset class, it remains very relevant. Now, the funny thing is that equities markets are all-time high. Gold itself is so all-time high. So the relationship between gold and equities is no longer what we used to know, where when equities don't do well, we look at higher gold prices. We don't see that anymore. So we see a positive correlation between the both markets. Again, I think this dynamics could be just temporary. I think when market starts to correct itself, I think the relationship will go back to its old ways. Again, you can't trade based on old relationship anymore, because the dynamics of the gold and equities market is very different right now. Now, interest rate is going to be something that is watch out for quite closely, especially in the US market. So now, as a way to hedge those risks, gold is always in favor. So why trade FGLD? As I mentioned, it's a local currency future, local gold futures contract. Good thing is that it's quoted in US dollars, so it's make it easier. So you don't have to calculate in your mind, during the currency conversion, before you actually make a trade. So quoted in US dollar, it make it even easier. And it's tracked quite closely with COMEX Gold. Obviously, there's certain times where it doesn't track that closely, but I think in general, most times it does track quite closely. Now, being a futures contract, it gives you the ability to long and short. So again, if you are looking at opportunity in the market, like I mentioned earlier, in any healthy trend, you should see a bit of correction in the market, and there's always an opportunity for you to short the market if the market is showing you technical bearishness. And futures market is always, again, a leverage tool, and leverage is always a double-edged sword. So if you get it right, you make it. If you don't get it right, you really have to manage your loss. So I'm just going to end here with a quote. Again, I want to emphasize this: don't focus on making money, focus on protecting what you have. This is quoted by Paul Tolujan. He's one of great trader. And if you have time, do check out this author called Tom Hogarth and this book called Best Loser Wins. I think this author really defined the definition of managing risk. So he got a quote that I find it very important to take note of. Is he always said he always believed in defining his risk, and it's never about defining his reward. So if you have time, just get on a local bookstore and check out the book Best Loser Wins. So with that, I'm just going to end here. Just going to hand it over to CY for any questions from the audience.